Today, we're going to talk about the 2023 recession. We're likely already in a recession, so I'm going to talk about what is happening in the economy. We're seeing a 500% increase in job cuts. We're seeing consumer spending crash. And I'm going to talk about how the stock market might respond just based off how it's responded to recessions historically. And you might be surprised to realize what the stock market actually does once the data shows we're in a recession. And then, as always, I'll show my own investing portfolio just for transparency so you know how I'm invested and how the stocks in my portfolio have done with this new economic data. Okay, first article we're talking about. Job cuts rise in November, causing employees to shift focus to career cushioning. US-based firms announced 76,835 job cuts in November, led by the tech sector. And this is kind of the big headline, right? Which is scary, but we'll get into the details and talk about why it's maybe not as scary as it needs to be or as it looks. The rate of job cut announcements at U.S. employers in November was more than 5 times greater than a year ago, according to a report by Challenger, Gray, and Christmas, whoever that is. Overall, U.S.-based firms announced 76,835 job cuts in November, led by the tech sector. Tech companies have announced nearly 81,000 cuts, so most of them have come in November, right? While the numbers seem staggering, total number of layoffs year to date is the second lowest on record since the firm began tracking job cuts in 1993. The lowest level was last year. When we're looking at layoffs across the board, while we have seen an uptake from historic low layoffs we've been in at least the last 2 years, we're not seeing huge mass layoff activity. Okay, so we're going to see some big layoff numbers. We've already seen them. It's scary. It hurts. People that are impacted, it definitely hurts. It's stressful. But right now, it's not worse than it has been historically. And in fact, we're coming off a period of very strong employment. And so it's to be expected that there's going to be some job losses. Now, this could get a lot worse. So it's something to monitor, but not something to panic about right now. What else is happening? Well, this key inflation measure that the Fed follows rose 0.2% in October, less than expected. So now we're going to talk about how consumers are spending money, which impacts inflation, the Fed raising rates, slowing down raising rates, which is what Jerome Powell just talked about yesterday. And we're talking about how that impacts the stock market. Inflation rose in October, about in line with estimates, sending a sign that price increases at least are stabilizing, the Commerce Department reported Thursday. Core Personal Consumption Expenditures Price Index, a gauge that excludes food and energy, and is favored by the Federal Reserve, rose 0.2% for the month and was up 5% from a year ago. Monthly increase was below the 0.3% Dow Jones estimate, while the annual gain was in line. Gains also represent deceleration from September, which saw a monthly increase of 0.5%, annual gain of 5.2%. Including food and energy, headline PCE was up 0.3% on the month and 6% on an annual basis. Same as September, while the annual gain was a step down from the 6.3% pace. This is why this is important. While the Fed takes a broad range of measures to gauge inflation, it prefers the PCE index, which is what we were just talking about, as it takes into account changes in consumer behavior, such as substituting less expensive goods for pricier items. That's different than the consumer price index, which is a raw measure of changes in prices. Okay, so this data is coming out. We're seeing, more bearish data, recessionary type data. The Fed talk about slowing interest rate raises. Well, what has happened to the stock market? Well, here's what happened to my own portfolio, which is very growth oriented. It was up $5,600 yesterday as Jerome Powell was talking about slowing interest rate hikes. Slowing interest rate hikes tends to be good for growth assets, so stocks in general, especially growth stocks. And you can see my little buckets here. Everything was up, right? Cloud and software as a service stocks were up 2%. This would have been more, except for CrowdStrike was down 14%. So that category would have been up very strong. Then advertising and e-commerce with Meta, Shopify, Mercado Libre was up huge. I think it was up 7 or 8%. Yeah, 8%. And then even EVs, space, and semiconductors, Taiwan Semi, Rocket Lab, and Tesla was up something like 5%, with all of these performing very well. So we're starting to see the stock market has gotten crushed and growth assets have gotten crushed, risk assets, as interest rates have been rising because of the fears of what that does to spending in the economy. We're also seeing this morning a strong reaction in the companies that I own. And so it looks like this rally is going to continue. Now, who knows? This is just 2 days. I'm a long-term investor, and that brings me to the final point. What happens to the stock market in a recession? We are almost certainly going, no one really knows, but almost certainly either in a recession right now or going to be in one in 2023. Recessions are not the end of the world. They are a natural function of a healthy economy. That's how economies stay healthy and don't get too frothy, right? We were definitely too frothy, but now this recession is a correction to that, and it helps keep the economy healthy and functioning long term. Now, this is from Vanguard from August 30th. Obviously, they benefit from people staying invested, right? But pretty sound company. Why investors shouldn't overreact to talk of a recession. Preliminary data suggests that the U.S. economy contracted between April and June for a second straight quarter. Investors wondering if we're in a recession and whether they should adjust their portfolios should consider history. This is really all you need to know. Stocks tend to begin to rebound during recessions in anticipation of a return to economic and corporate earnings growth. And here's a chart that shows that. Okay, this chart shows the one-year annualized return of the S&P 500 from 1973 to 2021, including its performance during the period 7 recessions. Recessions are totally normal. You're talking about 50 years, 7 recessions. In all cases, the stock market began to recover even as the economy continued to shrink. Stock recoveries may begin soon after recessions commence. Recessions have been relatively short compared with most investors' time horizons. The length of the last 7 recessions varied from just 2 months to 18 months, but it's definitely possible that recessions are longer, right? And then they just hammer home the point. There's no evidence that efforts to time the markets reward investors. Quite the opposite, in fact. So, stock market most likely won't have a horrendous, horrible crash that a lot of people are talking about. We probably are or will be in a recession. The stock market could definitely go down from here, but history shows once data shows that we're in a recession, the stock market tends to recover and do well from there. If we're long-term investors and investing for 10, 15, and 20 years, we should basically ignore this completely, and most people are best off investing in something like an S&P 500 index. Or I did a video on SCHD, which is an ETF that pays dividends and is pretty solid. And individual stocks like I invest in are very risky and have a lot of ups and downs, so obviously do your own research and know that before you invest. If you like this style of update where I'm sharing economic information without all the panic and stuff, do me a favor, like this video, comment below and let me know so I'll keep doing these videos, and then subscribe to the channel. Those things are the best thing you can do to help support this channel. It's free for you and help us grow. Thank you.